Oil giants switch to green energy. Discover how this will change the world. Recently, the conventional business model of oil and gas players is under a lot of pressure. So, investing in the sustainable power value chain can provide an opportunity to diversify and to play a leading role in the industry transitions. So, what does this mean for oil giants? Climate change is here, and humanity is already grappling with its effects and taking action in all parts of the economy. Sustainability has been a topic which many company leaders around the globe are thinking about more and more these days. Last month, Power published an article explaining how the hydropower sector hopes to enhance both new and current facilities through sustainability initiatives. But businesses across almost every industry are also putting a high priority on sustainability. As the move away from fossil fuels picks up steam in response to concerns about climate change, the oil and gas industry have developed a great interest in the topic. Major European-based businesses such as Total, BP, Royal Dutch Shell, Equinor, and Repsol are setting the standard by expanding their portfolios of renewable resources. Global production and consumption of energy must urgently and fundamentally change in order to transition to a lower carbon energy economy, and so businesses must therefore respond strategically to such disruptions. Oil and gas companies are hardly an exception, as their fossil-based products have long been an essential part of the landscape of the energy supply. They must navigate a landscape where more strict carbon reduction targets influence investment choices, and where and how to assist initiatives like offshore generating, EV charging, and hydrogen production as well as development are highly ambiguous. Operating models for both new and established organizations are rapidly evolving as a result. It's not new for oil and gas firms to enter the power sector. State-owned national oil firms and private international oil companies have long made investments in cleaner energy sources. The first significant oil corporation made an investment in renewable energies at the start of the 1980s by promoting the production of solar components and the development of solar and wind projects. It got a share in one of Europe's major solar developers about 40 years later, and then another oil company made a number of investments in the 2000s, and over the last 10 years, it has created a renewables and energy solutions arm and invested more than $5 billion in a range of business models, including renewables generation, power retail, distribution generation, energy services, and EV charging. Recently, one of the biggest NOCs in the world declared an intention to invest heavily in renewable energy to reach net zero emissions by 2050. Others have vowed to invest billions over the coming years to establish a renewable energy company and start a $500 million fund to finance energy efficiency and solutions investments. Now, even though there are indications that momentum will continue as consumer demand for cleaner energy increases and governmental incentives to decarbonize, the success of these expenditures has been uneven. Companies in industries like liquid fuel, power, and energy manufacturers that are structurally aligned with the energy transition are valued more highly by capital markets. But on the other hand, significant increases in business valuation have not yet occurred for the major oil and gas corporations that have the greatest stake in low-carbon markets. According to research, some of the largest companies start to benefit when their total portfolios contain more than 40% low-carbon investments, whereas the largest oil and gas companies often invest less than 25% of their new capital in alternative energy sources. There are a number of oil and gas firms that are in a good position to take the lead in the energy transition. This is due not only to their size on a global scale, the willingness of their investors to take on risk, their sizable balance sheet and cash positions, and their established relationships with energy consumers along with stakeholders, but also to their distinctive ability in offshore projects, hydrogen production, and the transport of sustainable fuels. This begs the question of how much pressure these corporations are under to alter their business practices. The social license to operate for oil and gas businesses is weakened when people get alarmed about climate change or demonstrate in the streets against pipelines. In a similar vein, it's bad for business when institutional investors and credit rating agencies withdraw their support for the oil and gas industry. An astute public relations plan in response, but at the same time, can go a long way in building goodwill. At the same time, the government provides significant support for the oil and gas sector, cushioning such influences. According to GSR 2021, investments in renewable energy in 2020 totaled a little over $300 billion compared to approximately $500 billion in fossil fuel subsidies in 2019. The Energy Charter Treaty's provisions, for example, safeguard the fossil fuel industry at the cost of the renewable energy sector. The status quo is easily maintained because a number of oil and gas businesses belong to trade organizations that fight against climate action. Little motivation exists to transition as a result of all of this. Targets are no doubt challenging, and their worth is debatable. It might be encouraging that oil and gas corporations are setting 2050 net zero emission objectives, but this is more greenwashing. European powerhouses BP, Eni, Equinor, Repsol, Shell, and Total Energies all declared net zero emission goals for 2050 by the end of 2020. But there are significant disparities in coverage and ambition due to the lack of standardized definition for a net zero target. Since intensity-based targets are based on emissions per unit of energy, they can be met without reducing fossil fuel production by merely raising the fraction of low-carbon production. A corporation has not necessarily lowered its emissions in absolute terms, even if it met its intensity-based emissions objective. Such goals encourage emissions reductions using only partial solutions. For example, Chevron, ExxonMobil, and Shell have begun partnering with renewable energy firms through the signing of long-term PPAs to get renewable electricity to power their oil and gas activities. Even though they reduce their emission intensities, their absolute emissions may not be much affected. Just like this, Shell disclosed in early 2021 that it has invested significantly more on oil and gas production and development than in renewable energy. On the other hand, the absolute emission reduction target holder BP declared in 2020 that it aimed to reduce oil and gas output by 40% from 2019 levels by 2030. Now, even if the amount that oil and gas companies are investing in renewable energy is unknown, it is quite small. The majority of oil and gas businesses with net zero goals also have specific goals for renewable energy, where there is less room for ambiguous language. Total Energies intends to add 35 gigawatts of renewable energy capacity by 2025. Eni and Repsol both aim for 15 gigawatts by 2030, while Equinor plans to install 12 to 16 gigawatts by 2035. BP also has a goal of 50 gigawatts by 2030. Even the most ambitious of these goals, though, are meaningless until these businesses actually put money on the table. There is evidence that oil and gas firms continue to be hesitant to diversify significantly into renewable energy and still prefer to safeguard their core operations. Fossil fuel subsidies from the government must be eliminated. Absolute emission reduction goals must be commonplace. But to close the investment gap in renewable energy, oil and gas corporations need to reallocate large funds, particularly in fields such as geothermal energy and offshore wind power, where there are chances for technical talent transfer. It will be challenging to remain upbeat about their transition until then. What are your thoughts on this? Let us know in the comments section below. If you enjoyed today's video and found it interesting, make sure to leave us a thumbs up. And don't forget to subscribe to our channel and click the bell icon to always be updated with the most exciting content as soon as it's uploaded. Thanks for watching. See you again soon in another video.